that most people know of or they may have set up for themselves. This is a policy that the reason why most people get it, and people who have a lot of money or they want to protect their money, they're not getting these policies for debt. You see, most traditional life insurance offers you a death benefit, and people are getting those accounts for the death benefit. But this policy is about the living. It's for you while you are alive. It has living benefits, so God forbid if you ever get sick, an accident, as an adult, you're covered financially. Or maybe you don't get sick, you're saving your money. So this policy is about saving money and having living benefits. The life insurance is not our top priority. Our top priority is having living benefits and cash value. So when someone gets an IUL, which stands for Index Universal Life, which by the way, Transamerica is the #1 selling IUL 8 consecutive quarters. That is our parent company. They're A-rated company. And again, we cannot rate ourselves. The industry has to rate us. So we're AM Best A, Moody's A1, S&P A+, all A rating. So when you save money in an Index Universal Life, it has a savings component that can earn up to 13% maximum. So that is your cap. So how many of you are saving money right now that's giving you 13%? And where? Well, we already know it's not happening at the bank. The bank will never give you 13%. Now you could get 13% in the stock market. So let's go over to the safety section. Everything that goes up also come down. So with a safety, Transamerica IUL guarantees you that anytime the stock market is negative, we get 0.75. That's the guarantee. So that is our worst case scenario, when most people, that's their best case scenario. The banks don't even give you 0.75. But in order for us to get 0.75, everybody else is losing money. Everybody else. The stock market is down. So while they're crying and losing their money, we're over here smiling. We didn't lose a penny. In fact, we made money, 0.75. Now, this money can be accessed tax-free at any age. A lot of you may have a 401k at your job, a 403b, IRA, mutual fund stocks, and that's good. But guess what? It's not an IUL. So when you're ready to take money out of those accounts, if you're under age 59 and a half, which most of you probably are under 59 and a half, you're going to get hit with penalties and fees for touching your own money. So if you're in your 20s and you're saving money to buy a house, to start a business, or any major future endeavors, you will take money from those accounts. And because you're under age 59, you're going to get a 10% penalty and pay taxes for touching your own money. Is that fair? No, it's not. But that's how those accounts are set up. The fourth box talks about protection and living benefits. So what are we protecting? 3 things. You're protecting your life first and foremost. If we pass away prematurely, there's a death benefit that gets paid out to your loved one. The second thing you're protecting is your health. cancer, heart attack, stroke will wipe it out, your finances, in under 2 years. Or it could be something simple as a car accident. Now you have to take money from your savings or wherever you have money, if you have any money saved up in other buckets. So you're protecting your health with living benefits. Again, this plan is about cash value and living benefit. So you're spending money on yourself while you're alive. And the third thing you're protecting is your money. Because we live in America where the minute you sneeze too hard, somebody's ready to sue you. You have a building, you don't clean your snow, and somebody fall and break their leg in front of your building, they're ready to sue you. So you're protecting your money. You're protecting your money from predators. You're protecting your money from the stock market, because again, it's going to go down. It's not a matter of if, it's when. It's going to go down. So when you have this plan, you are in control of your future. You're saving money. You're growing your money. It's protected. You can access it at any age, tax-free. And you got living benefits. So, I want to show you guys a 20-year look back. For the folks who probably are investing in the stock market, this is S&P 500, this is the US economy. We have Euro stocks, which is Europe economy. And we have Hang Seng, which is Asia economy. These are actual numbers, how the stock market performed for these years. Again, Transamerica has a 13% cap. So anytime the stock market is above 13, we don't get above 13. We give up some of that upside potential to guarantee no loss. So let's say we all started with $10,000. Somebody has traditional investment and somebody has an IUL. Your $10,000 in 2003 was good. The market was up 23%. So your $10,000 grew to 12. The person with an IUL, his $10,000 only grew to 11,300 because again, the cap is 13. In 2004, 2005, 2006, 2007, the market was booming and we made good money. And everything that we earned in those first couple of years, in 2008, what happened? Wiped out. It was wiped out. All of your gains from the previous years took a hit in 2008, negative 40%. So if you were scheduled to buy a house in 2008, retire in 2008, send your kids to college in 2008, you're down 40%. So if you had 100,000 saved up in 2008, you're now down to 60,000. 40% was wiped out. We can't predict the stock market. We can't predict the future. So, negative, what happens to Transamerica? We don't lose a penny, 0.75, guarantee no loss. But if you really look at it, we started with 10,000 and in 2008, we already surpassed the person who's doing traditional investment. We got 17,000 here. Traditional investment with mutual funds, stocks, brokerage account, they have 11. 2007, the stock market did 9.91. We also got 9.91. 2006, the market did 18. We only got 13. So whatever the market does, we get the same unless the market is above 13 we don't get above. And when it's negative, we get 0.75. So as you can see, the market is going up and down, but the average person is not tracking this up and down. All they know, in good years, they made money. Bad years, they lose money. But they're not tracking the total average of the sum of all these years. Well, we're in the financial service and we're tracking those numbers. So from 2003 to 2022, in 20 years, the average between those three economies was a whopping 5.88%. So people tell me that, well, I made money in the stock market. And I say that true. You are going to make money in the stock market. But in IUL, you're going to make more. You're going to make more. Yes, the market is going to go up and down. Yes, you're going to make money. But it's about saving money smart. So the person who started with their 401k, 403b, IRA, you name it, traditional investment, their 10,000 grew to 31,000. But guess what? This 31,000 is going to get taxed now by Uncle Sam. And all along the way, this person had no life insurance and they had no living benefit. So if they had passed away prematurely, let's say in the year 2012, they had 16,000 to their name. 16,000 Uncle Sam will happily tax and then give your family the difference. Whereas if someone had passed away with an IUL in the same year, their family would have gotten 23,000 all tax-free plus the life insurance death benefit, whatever that amount was. If it's 100,000, $250,000, $1 million, that plus the cash value. So the person with an IUL, they also started with 10, and in 2022 or 20 years later, they got more money. They're at almost 48,000 tax free, and all along the way they had life insurance and living benefits. And I'm going to say it again, these policies is not about the life insurance. We don't get IUL for life insurance. In fact, we take the minimum life insurance, because these policies is about cash value and living benefits. Now, I talked about Playground Millionaire. We're showing people how to set their kids up to be millionaire. But these same plans, IUL, can be used for whether you're a baby, 18-year-old, 25-year-old, 30-something-year-old, 40-something-year-old, 50-something-year-old. It's the same strategy. So let's look at someone who are probably in their 20s, 30s, or 40s. You got a job. You're either going to be saving in two places. You're either going to save in the bank, which we know what the bank interest is going to be, 0. Or you might be saving in the stock market. That's going to go up and down. You can't control it. So I'm going to do a side-by-side comparison between traditional investment with an IUL. I already talked about the 59.5 rule. If you're in your 20s, 30s, and 40s, you're going to touch your money before age 59.5. Life is going to happen. You may want to buy a car. You may want to put a down payment on a house. You may want to take an emergency trip somewhere. Life is going to happen, people. And when life happens, you're going to be getting a hit because you're under age 59.5 if you want to pull money out from those accounts. And you're also going to get hit with a 10% penalty because it's an early withdrawal. You're not 59 and you're under 59.5. So now you get hit with a 10% penalty. You have no life insurance. You have no long-term care, no critical or living benefits. And even if you have a lot of money in your 401k or your investment account, how much is this going to go to your heirs? when we die. Death benefit taxable. You don't know how much is going to go to your heir. You don't know how much is going to get left to your wife, your husband, your mom, your dad, your siblings, your kids. You do not know. This money is going to be taxed. How much? Nobody knows, because nobody knows when they're going to die. Nobody knows how much they're going to have in that account. Nobody knows what the tax rate is going to be. Whereas an IUL, tax-free death benefit. So if you have $1 million life insurance coverage, $1 million tax-free goes to your heir. You get sick along the way between now till the end of time, you got critical, terminal, long-term care, all the living benefits. Yes, you do have life insurance. Yes, you have access to your money. No age requirement. Tax-free loans. Where can you get loans? Tax-free. Tax-free withdrawal. But the best part, guarantee no loss. Guarantee no loss. Never losing money means you're making money. I'm going to say that again. Never losing money means you're making money. Simple example, you go to the dollar store and the guy said, you know what? I'm not going to charge you tax on this 99-cent lip gloss. Just give me 99 cents. You just save 7 cents, which is the taxes. Stock market returns, tax deferred growth, and you're putting money with after-tax dollars in your IUL. Everybody needs an IUL. Well, if you can qualify. This is not your typical bank account where you go to some place, you put your social, you sign some forms, and you got it. No. You have to go through an underwriting where they're going to look at your health, because again, it comes with living benefits. They want to make sure you're healthy. You got to apply for this stuff and hope and pray you get approved for it. Hope and pray. Because when clients get declined, oh boy, we see the other side of them. Hope and pray. They also look at your medical records. I have a lot of people that tell me that I'm healthy. Well, insurance companies, doctors are even more rigid than your primary doctors. Why? They have a vested interest in the future. Because if something pops up in your health 10, 15, 20, 30, 40 years down the road, they're on the hook. They got to pay out. So they're going to go through you with a fine-tooth comb to make sure you're healthy. Now, for the kids, why do we want to set up an IUL for a newborn? Somebody who is newborn, barely 15 days old, as the minute they get their social. So some of you who don't have kids yet, when you get that social and you do become a dad or a mom, you're going to know exactly, because you're getting this information now. Many of us didn't know this stuff when we got kids. But you guys are in a fortunate position that you're able to get this information ahead of time. I had a guy last week. He's in his early 30s. He said, Odetta, I'm so glad I got my IUL. As soon as I get my first kid, I'm calling you. He got the information. He knows what to do now. I went to a baby shower 2 days ago, Saturday night. And I told the grandma, I said, listen, I'm going to need to talk. I'm going to show you the best gift that you could do for your granddaughter. It's not about the toys. It's not the clothing. It's not the tech gadget. What I'm going to show you to do for your granddaughter is going to pay 10 times fold. So most people, when they're saving for their kids, they're going to save in two places most of the time. A college saving plan, such as a 529, or again, in the bank, or again, mutual fund, traditional investment. If you're saving in the 529, I'm going to tell you right now, you need to stop funding that account. Don't put a penny more in that account. Stop it immediately. Why? 529 is only for college. But you may say, well, Odetta, my child wants to go to college. Okay, you're going to see why I'm still going to tell you stop funding it. It's only for college. You may want your kids to go to college, but when that time comes, are they going to want to go to college? Maybe they change their mind. Things are different today. A lot of these kids want to be entrepreneurs. They want to make quick money. They want to start businesses. They realize, we all realize, nobody could be on this Zoom and say college is the only way to be successful. We've seen it over and over. It is not the only way to be successful. But if you have a 529, it's only for college. But you're going to say, well, Odetta, my child is going to go to college. Yes, they're going to go to college. They have to be a doctor. They have to be a lawyer. And they're going to go to college. Okay, so fine. But here why you still want to stop funding it. Assets weigh against you towards FAFSA, scholarship, and grants. You are literally disqualifying yourself from getting any free money. You are literally disqualifying yourself from getting any free money. And worse yet, if you got a couple of kids, no. Why would you do that to yourself? At my university where I teach, 90% of my students got free money. They got free money. And some of their parents sit on the board. So if they're making money, how come they got money? They know what we're teaching you. They know what we're teaching you. They already know that if you got money, you're going to have to disclose it on your 529 and automatically you're not going to get anything. It hurts you more than it helps you. Because to us, we see it as, okay, you got money, so spend your money. Whereas some of my clients that have IUL for their kids, they're going to get the free money. They're going to get the grants. They're going to get the scholarships. They're going to get the merit grants. Why? Because they're not disclosing that they have money, and certainly they don't have a 529. My own cousin who works at Kings County, she was so happy to tell me that I got a 529 for Aiden. I said, girl, we need to talk. When I showed her this, at that time, Aiden was 4 years old. So she had only started contributing for 2 years. She stopped it. His IUL is popping. His IUL is sweet, okay? 8-year-old, her only son, his IUL is sweet, sweet, sweet. And I know it because I'm the one that did it and I see his policies. So guess what? We're setting him up to get free money when he's ready to go to school. We're setting him up to make sure he has money for a car, if he has to go out of school, out of state, to buy whatever he needs to buy. Or if he changes his mind and he doesn't want to go to college, he's still going to be good because we set him up that way. So again, IUL, assets do not weigh against you. You could use the money for anything. Anything. 529 is only for college. Okay, and then once you're done with college, what's next? Once you're done with college, what's next? You're going to get hit with a 10% penalty. And you got to hope and pray the stock market don't crash the year you're ready to go to college. Because now you would just lost a lot of money. Right? So it's about saving money smart. Now, this is one of my favorite slides. I get really extra hype when I see this little baby boy, okay? This is my future millionaire baby boy, okay? So look at him. He's got a full head of hair. He is laughing because mommy and daddy set him up. He doesn't even know his entire future is mapped out because he got an IUL, right? So I talked about Transamerica earlier and I'm going to talk about it again. Here's some stats. 25 years in the IUL marketplace. 25 years. 497 billion generated in investment. 52 billion was paid out. Insurance claim, retirement accounts, annuity claims. So in the last 25 years, people who had a life insurance with us, an IUL, and they were saving, they had a retirement account with us, they had an annuity claim with us, 52 billion was paid out. They got their money. They got their money, right? 12.9 million policies in force. This may seem like a big number, but when you put it into perspective, New York City alone has 9 million people. There's so many people that do not know about these strategies. And then we have 11.8 million customers. The numbers are big, but they're not big enough. They're not big enough. And this is why we do these webinars all month of July, every Monday and every Friday, 7 p.m. So when you save in an IUL, these are the 4 main things. Yes, you have life insurance. So when you pass away, not if, because none of us are going to get out alive. When you pass away, the death benefit from an IUL will help replace income. So if you're a husband and a wife and you have an IUL, when one person passes away, that death benefit can help replace the income, because we're not here to pay our half. It could also be used for a legacy for grandchildren. I was speaking to a client today. Her home is in a trust. And I said, wow, how come you put your home in a trust? She said one word: legacy. Legacy. I want to leave a legacy for my generation. My kids, their kids will always have a home to live in. Free and clear, paid off, locked up in a trust. No children or grandchildren can say they want to sell it or fight among themselves to sell it. It's in a trust. Legacy. So when you have a life insurance, that is legacy. And all that money is tax-free. That's going to pass on. The government can't take a penny of it. That's why you'll never see a commercial by the government promoting these strategies, because they cannot make a penny off of it. I talked about the cash value that's built up. We don't get these policies for life insurance. We get these policies to build cash value. Supplemental income. A lot of my families, they use these accounts, including myself, because I have 3 IUL. That's going to be income. And then, of course, living benefit. We don't know the future. We don't know what's going to happen with our health. As we speak today, Monday, July 10th, my friend is burying her daughter, who is 31 years old. 31 years old. We don't know the future, right? So this is what I'm going to go through an illustration of what it looks like if you're saving $383 per month. Some people can save more, some people can save less. This is why you want to get in touch with a person who invited you on this webinar, so we could run numbers. Now you see, an IUL is like filing taxes. Everybody's number is going to be different. Everybody's goals is going to be different. Some people are going for cash value. Some people are going for living benefits. Some people are going for the death benefit because they want to leave a legacy. Some people are going for the tax-free. Everybody got something different. Some of you could go to the same tax person. One is going to get a refund. One is going to have to pay back. One is going to get a bigger refund than the other. So when you sit with one of us, we can customize based on your needs, your goal, and your monthly contribution. I will tell you, the more you put in, the more you get out. So we're going to focus on the green tab that is non-tabular, that is non-guarantee, current projection 7%. The first tab that says guaranteed 0.75, the only way, again, we get 0.75 is when the stock market is negative. And this will almost never happen. The stock market would never be negative for 20, 30, 40, 50 years in a row. God damn, it's not even negative for 5 years in a row. That would be like an apocalypse. So the green tab that shows 7%. And again, these numbers are very conservative because I've shown you a 20-year look back where it averages about 8%. So 5 years, we start this policy for a newborn. When he's 5 years old, the cash value is $21,000. We know there's probably not a lot of 5-year-old that has $21,000. When this child is 10 years old, they have access to $53,000. When they're 15 years old, $96,000, almost $100,000. 20 years old, $154,000. Now, there's probably a couple of 20-something years old on this Zoom right now, or 30-something year old, right? So at 25, how many people have 233,000? You don't have to put it in the chat. Think about it. If your parents had started this for you 25 years ago, this is the kind of money you would have today. Over 200,000. And this is what you get to do for yourself. If you're in your 20s, your 30s, your 40, you've got 20, 30 good years to do this for yourself. And now at 30, we got 339. Guys, these numbers, again, it's very conservative. If you Google, and you guys should probably do this just for your own knowledge, if you Google what is the average savings in a 401k for a 30-year-old, a 40-year-old, a 50-year-old, you're not going to see these numbers. 35-year-old, 478,000 tax-free. Google it for yourself. What is the average 401k account value for a 35-year-old? Number one, we're not saving enough. That's the first thing. And number two, we're not saving smart. We're saving in accounts that are giving us a fixed interest, which is very little. That's not even keeping up with inflation, i.e. the bank. Or we're investing in the stock market and we're on a roller coaster. One time we make money, one time we lose money. So the millionaire mark, 48 years old, this child is a millionaire. A millionaire at 48 years old. A millionaire. I don't know. And I should say, not just a millionaire, a tax-free millionaire. Because some people might be a millionaire if they have a home, but that's not tax-free. Or they may be a millionaire if they have investment, but that's not tax-free. And what did I say? Tax-free money means more money. So you can take money out all along the way. Because again, your money is liquid. You could take money out for every major milestone in your adult life. You plan on buying a house in the next 5 to 10 years? Beef up your IUL. You want to use this account to start saving for your future? Beef up your IUL. And it just keeps getting better, right? So you do this for a kid, but it's going on to the next generation. So at age 60, right? Again, look at this number, 172. We contributed a total of 172,975 because that's the 380 something that we've been putting away every month for 60 years. We put in a total of 172. And look at this. The cash value is 2.1. You will never, ever, ever get this with no other financial strategy. You put in 172 and it grows to over 2 million? Where's that happening? Not even a mortgage. Because with the mortgage, the bank is getting us. Oh, the bank is getting us with those interest fees. You end up paying like 2-3 times for that house with the interest. The bank is getting us. Right? And now at 65, Well, by the way, you don't even have to wait until you're age 65. Retirement has nothing to do with age. Retirement has everything to do with money. So if you wanted to retire in your 40s, your 50s, your 60s, listen, we got over $2 million. Age 59, you got $2 million. Age 60, you got $2 million. And all along the way, you're in control of your future. You're in control of your future financially. If life knocks us down with our health, we got the living benefits. If we pass away prematurely, depending on when, hey, if we pass away at age 55, is your family going to be crying for long? With 2.8? Oh boy, you're going to have a wonderful send-off. Right? So we start these things for ourselves because, again, it's about cash value for you to spend on yourself while you're alive. And yes, if we get sick, we have access to money. And yes, whenever we die, we leave a legacy behind to the next generation. Too many of people in our culture are dying and leaving debt. We can change that with strategies like these. Because now, let's say this person passed away at age 95. Look at the debt benefit. 14 million. Like 14 million. Lisa Marie Presley died earlier this year. Does anybody know how much life insurance she left? Put it in the chat. Lisa Marie Presley, Elvis Presley's daughter, passed away early this year. Does anybody know how much life insurance she left behind? How much was she insured for? When she died, her estate blossomed. Her estate got richer. Does anybody know how much? When Elvis Presley's daughter passed away, how much life insurance did she have? Nobody knows? How about Kobe? Because Transamerica was the one that insured Kobe. Does anybody know how much life insurance Kobe Bryant had when he passed away? Because we saw the check. Transamerica paid the check. Yep, a whopping 30-something million. I think the number was either 30 or 33. It was in the 30s. It was in the 30s. So you would be thinking, well, why are they getting so much life insurance? They're not getting it for burial, people. They're not getting these policies for burial. They're getting it for legacy, tax-free money, right? So that's what we want our community, our people to learn and understand and also do, because we can change the narrative. The next generation has to be better. And this is why my fourth book, Playground Millionaire, is my contribution to society, that the next generation has to be wealthier. They have to be educated financially. Because if we don't know this information, we're going to continue doing the same thing that we've been doing. So, with that being said, all of you that have guests, we will be reaching out to you to see what is it you want to do. Now, what I've shared with you tonight is on the client side. This is the IUL. But we do so much more than IUL. Our parent company is Aegon. We've been around almost 200 years. They're based in the Netherlands. And then we have Transamerica, which is based in San Francisco, 119 years. And WFG stands for World Financial Group, but lately we've been hearing a whole bunch of other stuff, right? Working for God. So what we do is we teach people about money. We show people how to save smart. It's about saving smart. It's about getting more bang for your buck, paying yourself first, saving the right vehicles for your retirement, saving in the right vehicles for your kids' education, having proper protection on your life, your health, your money. And we do this through insurance and investment firms. These are some of the companies in our platform, right? And our motto, like Roland said in the beginning, is simple: no family left behind. Whether you move forward with a strategy or not, our job is to educate you. Education, education, education. That is key. And whenever you're ready, you're going to call us, right? No families left behind. You cannot say you did not know this information. 91% of us are underserved. Listen, I graduated from NYU. Never took a personal finance class. The university that I teach at, they don't even mandate a personal finance class. So we're preparing our kids to go get a job, but they don't know how to manage their job paycheck. It's crazy. So I can tell you firsthand, being in the education field, we totally failed. We totally failed. But that's a whole nother story. It's beyond our control, and the IRS and the government, they love it that way, because as long as these people don't know this stuff, guess who's taxing that money? Not you and I, the government is, right? So only 9% of people are financially educated, and our job is to make sure it's the opposite. Everybody should be financially educated. Everyone deserves financial education. We didn't get it in school. Some of us never grew up listening to conversations about money, but we are. And speaking of money, I want to show you our compensation track. We're expanding. We're looking for people who are looking for us. I'm going to say that again. We are looking for people who are looking for us to teach this information in their community. Teach it in churches. Teach it in schools. Teach it at libraries. Lunch and learn for corporations. Everybody needs to be financially educated. Now, to do this business, again, we're in the financial service. It's a process. You'll require a license. I can't give you your license. You got to study and earn it, and the state give you that license. Now, once you get that license, not only you can help a lot of families, but you can change a lot of families' lives. Because when you sit with a client and you educate them on these strategies, and you put a strategy in place to help them save money, let's say $250 per month, which is $3,000 per year. Everybody starts as a trainee, which is the entry level, 30% commission contract. 45% once you move up from trainee to associate. And if you want to build a team, you could be a marketing director where now you have licensed agents. And if you want to grow even bigger, you could be a senior marketing director where you have more licensed agents. So when you help a family save money, not spend, we're not promoting spending here. We're promoting saving, and saving money smart. So as an associate, when you help a family save $250 per month, you get paid $1,350. 2 hours of your time on a Zoom, because everything we do on Zoom. You could be in your house in New York, and you could help a client in Dallas, Florida, Vegas, Georgia, wherever the client is. You educate them on a Zoom. You put a strategy in place for them to save money and protect themselves. So in closing, right, you have two choices. One, you could say, you know what, this sounds great. I want to be part of this organization. I want to get the license. I want to go the business route. Two, well, I'm not sure I want to do the business, but I need to save my money and build wealth. Or three, you want to do both. Let's poke a hole in the sky, become a business partner, save your own financial future, and teach this information so that others can save theirs too. So thank you guys so much. We will be back on Friday, again, 7 p.m. all month of July, Mondays and Fridays. Some of you, if you want to come back and hear it again, you already have the link. It's the same link. Just log in Friday, 7 p.m. Some of you may already know you're ready to take the next step. You probably have some questions, but you're ready to take the next step. So get in touch with the person who invited you, or in fact, The person who invited you will be reaching out to you as soon as we end this Zoom. They're going to reach out to you and see what is it you want to do. Do you want to be a business partner or do you want to save money? That's really it. So Roland, I'm going to turn it back over to you, and thank you guys so much. We'll see you on Friday.
Okay, thank you. Thank you to everyone that logged in tonight. And as Odetta said, we will be reaching out to you to follow up